Um, Good morning, good afternoon, everybody. My name is Victor Jiang. I'm the chapter president of Keiretsu Australasia, also the co-founding partner of Sapien Ventures. Today I'm the great pleasure to introduce someone who I consider an absolute industry heavyweight and pioneer in the Australian venture capital space, and someone I have a great privilege to be able to call upon as a colleague these days. His name is Roger Buckeridge, and he's a co-founder of one of the very first VC firms in Australia, Allen and Buckeridge. And please join us, Roger. Are you online?
Yeah. Yes, I think so. Hi, Victor.
Hi, great to have you here today and sharing a few gems of wisdom, hopefully, with the audience today. I was doing a quick surveying of some of the attendees for today. It's actually quite an international audience. People are dialed in from North America and Southeast Asia to the ones I know. So for those that may not be too familiar with Australian ecosystem, could you just give us a little bit background of where you've come from and your journey, especially in the Australian VCPE space?
Okay, first of all, I want to shout out to Graham Taylor, who's an old pal of mine, who he's on the call today, and he's known me since I started out, which actually was in the mid-80s. When I founded what is effectively a listed investment company on the ASX, because we didn't have venture capital organised structures in, and we hardly had any pension funds. And basically, I remember from 85 through to 90, I was running this listed company through the 87 stock market crash, and it started out by having a tax advantage, which got private client money from what was then Potter Partners. And it had some corporates, an Elders IXL related pension fund and a Dalgety fund amongst them. And we basically did biotechnology and software startups in the mid 80s. And it was a great ride. I remember I was in the seed round for Cochlear and a few companies which became very large way back when. But it was interesting background because I learned that basically investors put money into companies thinking they're going to get dividends. So it was very amusing to me about a year into this thing, which was about 1986, I guess, about a year before the big stock market crash. I got a couple of calls from people saying, "Where's my dividend?" And I said, "Well, basically we're doing startups and this is a long-term capital gain play." Oh, quick. The phone was slammed down on my ear and I never heard from them again. But the tax benefit at the time they invested. So you had to raise your money wherever you could find it. That was my learning experience there. It all came to a crashing halt with the industry in the 1991 recession, the last big one that Australia had generically, which was very severe. And it really closed down the organised VC industry for about the next 5 years. And I went off and did other things, many R&D institutes and a few other things just to get a living. But back in 96, 95, 96, Roger and Alan and I, who'd been partners in the earlier business, him as a non-executive, we decided to set up a more formal Silicon Valley style venture fund. It was unit trusts then. We didn't have venture capital limited partnerships or any of those later initiatives. And basically the Australian pool superannuation fund industry was then starting to grow quite quickly. And a bunch of the first industry funds, some of the not the retail funds, but mainly the industry, the prototype industry funds, decided, well, they better have a look at this thing because they were talking to the pension funds in the US and they could see big money was being made in an emerging asset class called venture capital, and these guys in Australia had never heard of it. There was what I would call a beauty parade, which was held, and about 5 or 6 managers, of which we were one, got some money. It took us 18 months to get our first commitment, which actually came from what was then New South Wales State Super, became Axiom and grew further. And basically that was our first. It was about another, I guess we got that about a year in, and it took us about another 6 months to sort of get to a first closing on our first Allen and Buckeridge fund, which started investing beginning of 1998. We then did another fund, a bigger fundraise in 2000, which closed just before the dot-com crash, which again caused dramatic reductions in valuations. In fact, a complete winter again for venture capital in Australia. So actually, in hindsight, we were mainly investing in IT type startups, software, but also quite a lot of hardware. So there's quite a lot of startups which syndicated with the hardcore, well-known venture capital names in Silicon Valley. You know, doing chip design software, and you know, quite some of it was really quite deep. There we would find an Australian innovation out of a university usually, and build a company around it, and then form the business model in those days, because there was no domestic market, no domestic infrastructure, and very difficult to raise even A round, let alone B or C round capital in Australia. So a very immature marketplace. So that meant really in the dot-com era, to my view, most of the opportunities had to be ported offshore, almost all of them to the States. We did one or two to UK, listed on the London Stock Exchange. There are a couple of outliers, so two or three, particularly network management services companies into Asia, where we had lots of branches and the like, so they've become quite valuable. But they were outliers. It was primarily find the tech, build a team. Often we had to do the recruitment to build the core team, and then port the company over to the States to get it funded beyond the seed and maybe A round, beyond the first 3 or 4 million of investment, basically. So that was the environment in the 90s. It was very capital constrained in terms of the whole VC private equity system.
So on that, if I can just interject with a question on that. I mean, venture capital as an industry sector or asset class is not that well understood in Australia today. I think I can say that after being 5 years in this game myself. But back then, 20, 30 years ago, to your point, many people, fund managers, responsible for large quantums of capital have never even heard of venture capital. So how was it that you were able to, in the initial phases, able to attract that capital into your fund?
Well, as I said, it really came to a process. It took us 18 months to get to the first closing with a well-managed, very well. Elizabeth Bryan was basically the senior investment manager then in New South Wales State Super. She was very competent, of course, went on to have a storied career, professional career, as a very senior director. So she took a lot of persuading, and we had to use the example of the track record of the industry in the US, basically saying there's no reason why we can't actually participate in this stream. So one of the things that Roger and I did was actually hire a lady named Sandy Plunkett, who was a journo for IT journo for PRW magazine, and we re-domiciled her to the Bay Area, and she was there building our name around the VC community there so that we could syndicate. And she did that for about 1.5 years before she got hired by a fast-growing Silicon Valley venture-backed startup. But it was good. It was a valuable thing to do. And look, the other guys in the industry, I mean, you were talking about people like Daniel Petrie and those guys basically, and the guys who used to work with us and then spun out to form Southern Cross partners. You know, a lot of them had business backgrounds and domiciles in the US. So very much a bi-coastal sort of thing, because that was the structure of the global VC market at that point. Now, of course, it's dramatically different now. The other thing I should say is, as I said, there was a beauty parade. So basically, we had to go and front these chief investment officers for big funds at those days like UniSuper, which is one of them, and the Commonwealth Super Funds. And basically, these guys have seen every scam artist you can imagine in Australia. After all, this is the land of mining entrepreneurship, right? So they could see a dud person when they saw one. I mean, some of these guys were very seasoned. And so it was a process of building some sort of confidence on their part that we knew what we were doing and that we were honest. It was very personality based. It still is to some extent. Although, I mean, there was no, everybody was doing a first fund. So they couldn't fall back on the old saw in the States where it says, oh, well, look at you, we'll get to know you and we'll invest in your third fund. So they couldn't get away with that. They had to put a toe in the water and actually, back some people or not. And so a number of people who are still very active in the industry got their start in the early stage part of the marketplace. Bear in mind that at the same time, you were seeing the first private equity funds. So I used to know Bill Ferris and Joe Skrinsky very well. He started up Aussie Mezzanine, which became Champ. It became, the doyen of Australian private equity funds. Again, they operate in a parallel. It was a totally separate marketplace because, of course, they were accessing public companies, they were accessing debt marketplaces, which is an anathema to early stage VC. So, they were completely separate, really, market segments, and they still are to some extent. Although now, of course, you have a much deeper, more experienced group of participants in both the VC and the PE market in Australia. And of course, today, the amount of annual new commitments to pool venture capital is closer to matching qualified demand. Whereas when we were in the game through to the mid 2000s, basically, the industry might raise a couple $100 million a year, and there's really 500 million a year at least of qualified demand. So there's always a big imbalance.
Speaking of which, the size of the fund that you run at the time would have represented a significant share of total VC market, right?
No, there were other people, particularly in the biosciences thing. See, the biosciences sector, GBS Ventures and Brandon Biosciences are prominent. Those guys were raising $250, $300 million funds based upon the world-class bioscience hotspots in Australia. Mainly Melbourne, but certainly in Brisbane and Sydney as well, and a bit in Canberra. So there was a very deep tech base in this country, which had been funded by governments for many, many years. And so they got some great success out of that. And there are still a few of them still exist. They're very specialized. There aren't that many specialized VCs. And one thing I learned is, well, if you want to understand how to make money going through 10 years of phase one, 2A, 2B, and 3 trials to get a product to market, you've got to know big pharma around the world and spend a lot of time with them, because you're basically not going to get liquid unless you can get the support from one or other of the big pharma companies. And I think that's still to a great extent the case. It's a very specialized vertical in the industry.
In your observation of the market or the industry for VC today, would you say that there are some structural differences compared to, say, the 90s or the early noughties, where funds will still be investing in the seed or angel or A rounds of companies and then take them to the States or Asia?
There are a couple of structural innovations which were basically driven by people's obsession with tax. It's always made me a bit amazed, really, because to have to pay tax, you've got to be really successful. So what a nice problem to have. But basically, getting people with their own money to put a small percentage of their total investable assets into early stage venture. So you have the early stage venture capital limited partnerships and the venture capital limited partnerships, which were innovations by the Australian government that have become now pretty broadly accepted. They do have significant tax benefits, particularly the early stage ones, but they're highly regulated. And from a commercial point of view, having some bureaucrat in Canberra always having the risk that they may challenge the eligibility of an investment you choose to make and how you want to grow a company is basically what I call a non-market driven intervention, which isn't welcome. Basically, it's a pain in the butt. But if that's what you need to tap high net worth individual investors, qualified wholesale investors into risking a bit of capital in this market, well, that's just the structure of the marketplace, and you have to do what you have to do to get the capital committed. So there are some quite large pools now being, so I think there are several early stage VCLPs which are now like 200 million in committed capital. So they're not just small pools of 10 million each.
Yeah.
So it has allowed people to tap a broader array of what I would call high net worth qualified investors. Typically, tax doesn't drive the pension fund, the super fund industry, because they're tax advantaged anyway. So it's not really an issue with them. There it's all about risk management and can we trust these managers not to lose our money.
We just saw two very interesting companies, one from India, one from Australia. Apart from advancements in technology, what would you say are perhaps the main differences between startups pitching for capital today versus back when you first started your funds?
It's the globalization. It's the globalization of VC. It's basically that American venture capitalists used to have a monopoly, and they used to select investments based upon basically how quickly could they get them close to where they live. You know, it was a totally biased marketplace and very efficient. I mean, I go back to 2000, 2001 when we had the dot-com crash, then the telecoms crash, which was much more serious in terms of volume of money lost. And the Silicon Valley guys just, just closed down everything they'd done in the 2000 vintage. They said, oh, this vintage isn't going to make us a big carry, so we'll close it down. They just raised the 2001 vintage from the same long-suffering pension funds. They always raise from. And so basically we had a lot of investments in the early stage, A-round stage, which suddenly were shut down. I can well remember Roger and I confronting that we didn't own 10% of a company, we owned 60% of the company. We had to make a decision, do we try and keep this alive, which we did sometimes, hard work. But basically, what kind of commitment are you making to your founders? Is it to be just fair with the sailors? You can get ideological about this, which I'm not, as you know, but basically, there is some sort of compact you make, particularly if you're going to be a lead investor with an early stage company that you're going to stick, deliver on what their best efforts, and you should stick with them and be able to continue to fund them.
So you funded in your time Australian companies and international companies. What were some of your proudest investments, both from Australia and perhaps one example from overseas?
Well, I remember once I did an analysis. I think Roger and Alan and I were involved in about 60 startups between 98 and about 2006. And I think we made money on a quarter of them, which meant that we paid our investors their money back. They were most astonished when they got their money back, plus a bit on the 2000 vintage in particular. We had many amazed messages.
Low expectations back then.
Yeah, well, I'll never forget it because they said, "What are you going to back us another one?" They said, "Oh no, too risky." so basically, but just getting the money back, they were astonished, and it was hard. It's been hard for Australian venture funds until recent years to even get their money back on their funds. So there's been many promising startups and management teams that have led to financial exhaustion. But in recent years, I've noticed as I spent a few years away from Australia and came back about a year ago after a few years mainly working in Europe and in Asia. And there's now a group of well-established managers who've had a series of successes, so it's just not one-time wonders. And I think there's a lot more confidence in the institutional investment community to keep on backing them. And so that's why you're seeing regularly now $400 or $500 million top-up funds every couple of years from the major players. But the trouble with that is they get too big, and therefore they don't actually do seed and A round stuff as easily as before. So they become more expansion capital providers to all VC firms, it seems to me, unless you spin off specific groups that focus back on seeding the pipeline. And some of them are doing that to some extent. So I think it looks healthy enough in terms of available funds. And then, as I was going to say before, it's not just America where you've got to actually find your exits. Now, of course, there's very sophisticated VC markets in Asia, dominated particularly by the Chinese marketplace, which I know you spent a lot of time interfacing with over the years, and I did too, particularly in the last few years when I was in Singapore. So, there's obviously geopolitical issues now about, does Australia really have to pick between China and the US? It's crazy if you have to pick, because anybody in an investment portfolio now who doesn't have a major position in both of those economies is sort of taking huge risk. So it's a conundrum to try and stay clear of becoming a football. But basically now, Australia's got quite well positioned. It's got relevant industries, which is, as you know, I'm very keen on things like sea forest. The whole agribusiness vertical is a great comparative advantage for Australia, and I think also anything to do with with resource extraction. I mean, the biggest, most profitable industry for many years in Australia has been mining. Doesn't employ many people, but it basically supports the income tax revenue to a Commonwealth government. And nobody should forget that. And the amount of innovation that's going on within the mining industry and in automation, AI, the use cases of broad advances in information technology is quite amazing. The thing for a venture capitalist is to form a view basically as to whether they're a buy and hold type investor or whether they're just investing to flip. There's too many people in software business and still are. Anybody to do with apps, something to building to flip, but they're not backable people. They're just hunters. So finding management teams that are really there for the long haul. So Jay, I see you're back. Are we done?
Yes.
Good.
That was fabulous, and I think a really good point to finish on is really about just talking about Australia's strengths and where the smart money could be in the next few years for companies coming out of Australia, and I've seen a lot of money go into mining tech that are now using that tech for other industries, including agriculture, and the ag tech scene is definitely one that's been booming over the last little while. So it's it's definitely very.
Well, there's just such bench strength and depth in Australia in terms of the technical talent that have grown up in resources industries and agribusiness, and so just being look, I'm very keen on Victor's business because I think he's the master of digital assets. And basically, that is a major global thing where you need, as an investor, to have a strong position in your diversified tech portfolio in that thing. And I think also anything to do with sustainability or resources, and Victor and I had a great conversation with the guy Jay, earlier this morning just about that very thing. So there's a big opportunity set, I think, for funds that have the investment management talent. That's what I keep on coming back as I talk to you and to Victor and others is who are the key guys who are going to pick the deals, who are going to nurture the talent that they find, be there for these guys as they go through 10 years of help, basically building a $1 billion enterprise. And finally, the people also have got the sort of ambition to take it to that level. Those people are pretty rare all around the world.
Yeah.
So if I summarize just very briefly, so active management and participation by the investment manager is absolutely paramount. Sector specialization is going to be paramount. Increased focus on globalization and tapping more major capital markets beyond just North America will be another. Would that be? Yes,
well, I mean, America is actually a decreasing part of the global capital market for funding innovation. It's still dominant. It's still probably the largest share, but China's probably getting close in terms of financial capacity, but there are cultural issues which make it difficult to access that relative to English-speaking countries. But we shouldn't by any means forget about the EU. England's a bit of an outlier now because it's spinning out, but the amount of capital formation in the EU and some of these long-term industries too is really quite remarkable. And they do have a long-term view. I've got a lot of respect for the Germans, believe me.
It's a good place to finish, particularly as we've